Today, we are breaking down a powerful, data-driven thesis that really cuts against all the optimism we're seeing in the market. It's a contrarian view for sure, but it's grounded in some very specific economic mechanics that point to a potential and silent crash in 2026. This isn't about chasing headlines, it's about the deep structural forces at play. So, let's get into it.
According to this analysis, the single most important number in finance right now isn't the inflation rate, it's not interest rates, it's this. $325 billion. And this one figure, it represents a massive, monumental shift in strategy from one of the most successful investors in the world.
So that massive number? That is the cash hoard of Berkshire Hathaway. And what's truly staggering here is the trend behind it. For 8 straight quarters, that's 2 full years, the world's most famous optimist on the American economy has been a net seller of stocks. Now, this isn't just some minor portfolio tweak, it is a historic move that signals a profound change in his perspective.
So that leads to the crucial question, right? What is he seeing that maybe the rest of the market is missing? Why is the ultimate buy and hold forever investor now holding a mountain of cash?
And let's be crystal clear about this. This isn't a passive move. He's not just waiting around for a better opportunity to come along. He is actively, methodically, selling off parts of his portfolio and parking that capital in the safest, most liquid asset on Earth, short-term U.S. Treasuries. This is a very decisive, defensive strategy. It suggests he's preparing for something big.
Okay, so now let's unpack the 2 core data points that really form the foundation of this entire thesis. This is where we need to look right past the daily noise and into the structural forces that are actually moving the market.
First up, we've got what Buffett himself once called the best single measure of where valuations stand. It's the ratio of the total stock market's value to the country's GDP. As you can see, bubble territory historically kicks in around 120%. The absolute peak of the dot-com mania hit 140%. And where are we today? An unprecedented 220%. We're a full 2 standard deviations above the historical norm. We're in completely uncharted territory.
And this brings us to the second and, maybe even more critical data point. It's not just about how high the prices are, it's about who is doing all the buying. As of late 2025, nearly 60% of the entire U.S. stock market is controlled by passive funds and ETFs. These funds, they basically operate on autopilot. Money comes in and they just buy, completely regardless of valuation. Now, this massive structural shift has created this really dangerous feedback loop. It's known as the Grossman-Stiglitz paradox. In simple terms, because so many investors just assume prices are correct and they blindly buy the index, there are fewer and fewer active managers left doing the hard work of figuring out what a company is actually worth. And as a result, the whole mechanism of price discovery starts to break down, and stock prices can become completely detached from their underlying value.
Okay, so if prices are at historic highs and the buying is mostly automatic, what's the specific thing that could actually trigger a crash? Well, the answer, according to this thesis, isn't some loud, sudden explosion, but a kind of silent suffocation, a liquidity crisis.
Here's the crucial plumbing issue that the market seems to be ignoring. See, in a normal market, when there are sellers, they're met by active buyers who think the price is fair. But in a world dominated by passive investing, what happens when those flows suddenly reverse? When a wave of selling starts, let's say from retirees taking distributions or a panic caused by a recession, those passive funds are forced to sell. But the active buyers who would normally step in to buy, well, they're a shrinking minority. This creates what's called a liquidity vacuum, where prices don't just dip, they gap down violently. This whole scenario is a textbook example of what the economist Hyman Minsky described. He argued that stability itself is destabilizing. Long periods of calm and prosperity encourage more and more risk-taking, which sows the seeds of the next crisis. And when that speculation becomes totally unsustainable, we reach what he called a Minsky Moment, the point where the whole house of cards just collapses. The Minsky cycle typically unfolds in 3 phases. First, you have the hedge phase. This is where smart money is buying good, valuable assets. Then comes the speculative phase, where investors start to chase momentum, ignoring value. And finally, you get to the Ponzi phase, where the only reason to buy an overvalued asset is the belief that some greater fool will buy it from you later at an even higher price. The source of this analysis argues we are firmly in that third and final phase.
And the evidence for that claim is pretty stark. The Shiller P/E ratio, which is a cyclically adjusted measure of market valuation, is currently hovering right around 40. This extreme level has only been surpassed one other time in modern history, at the absolute peak of the dot-com bubble in 2000, right before it all came crashing down.
So given this pretty stark outlook, what can an individual investor actually do? Well, the analysis doesn't just present a problem, it proposes a specific playbook, and it's modeled directly on what Warren Buffett himself is doing right now.
This quote right here is the absolute key to understanding the strategy. Buffett isn't holding $325 billion because he's fearful. He's preparing. He is, in his own words, loading the elephant gun. He knows that when a liquidity crisis hits, the selling is indiscriminate, and it will force even the highest quality companies down to bargain basement prices. In that environment, cash becomes the most powerful tool an investor can possibly have.
For you, the retail investor, this all translates into a clear three-step protocol. First, you build your dry powder, your ammunition. Start pooling cash instead of automatically reinvesting every dollar into a historically overvalued market. Second, do your homework now. Create a strike list of fantastic, resilient companies and figure out the price at which you would love to own them. And third, prepare yourself psychologically to just ignore all the noise.
The whole point of this protocol is to replace emotion with a predetermined plan. So when a crash happens and the media is screaming sell, 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 you don't panic. You calmly consult your list, you check your prices, and you act with discipline while everyone else is being driven by fear. This is precisely how wealth is transferred from the unprepared to the prepared.
Ultimately, this thesis isn't really a forecast of doom. It's about framing a rare window of opportunity. It argues that this passive-fueled everything bubble is, well, mathematically unsustainable, and its unwinding is pretty much inevitable. Warren Buffett has already positioned himself, so the question this analysis leaves us with is a simple one, but it's a profound one. As the clock ticks toward 2026, are you ready?